let's be honest. Have you ever looked at a company's financial report and just your eyes glazed over? It can feel like trying to read a completely different language. Well, you're not alone. And today, we're going to crack that code. We are going to break down the absolute core principles that tell you everything you need to know about a business's health. And I promise, no complicated math involved. So how do you do it? How do you figure out if a business is thriving or just surviving? Well, think of it like a doctor checking a patient's vital signs. You need a reliable, standardized way to measure what's going on inside. And for a business, those vital signs, that's accounting. It gives us that clear, honest picture of how things are really going. And here's the secret. At its very heart, all of accounting boils down to one super simple idea: a balancing scale. Seriously, on one side, you've got everything the business owns, and on the other side, you have all the claims against everything it owns. That's it. Every single thing we talk about today is just about keeping that scale perfectly, and I mean perfectly, in balance.
All right, let's dive in and look at the first side of our scale: what you own. In the world of accounting, we call these assets. Put simply, assets are all the valuable things a company has in its corner that are going to help it make money down the line.
Okay, I know, that sounds a little textbooky, right? Let's cut through the jargon. The only part you really need to remember is future economic benefits. That's the whole game. An asset isn't just a thing you have. It's a tool, a resource, something that's expected to bring value into the company in the future.
And when we say assets, don't just think of cash in the bank or the company's building. It can be less obvious things too. For example, accrued income is an asset. That's money you've already earned for a job, but the client just hasn't paid you yet. That future payment you're owed, that's an asset. Or how about a prepaid expense? Say you pay for your company's insurance a whole year in advance. You now own 12 months of insurance coverage. That right there is an asset.
Okay, so we've got one side of our scale loaded up with assets. Now, to make it balance, we have to look at the other side. If assets are what a company owns, then liabilities are what a company owes. These are all the claims that other people, banks, suppliers, you name it, have on the company's stuff.
Now, the key phrase here is the exact opposite of what we saw with assets. It's outflow of resources. A liability is basically a promise the business has to keep, a future sacrifice it's obligated to make. It's an IOU that means sooner or later, some of those valuable resources are going to flow out of the company. The most obvious example, of course, is outstanding expenses, the electricity bill or the rent you haven't paid yet. But here's a trickier one: pre-received income. Let's say a customer pays you in advance for a big project. You've got the cash, so that's an asset, right? Yes, but it's also a liability. Why? Because you still owe that customer the work. Until you deliver that service, that cash is a debt you have to settle. So there you have it, the fundamental push and pull of business. Assets are all about future value flowing in. Liabilities are all about future value flowing out. And keeping these two in balance, it's like checking the heartbeat of the business. It tells you everything about its stability and its health. So we've got what the business owns and what it owes to everybody else. But wait, what about what it owes to its owners? Well, the difference between those two sides of the scale, what's left over, that brings us to our third and maybe most important core concept: capital. To put it really simply, capital is the owner's slice of the pie. It's what would be left for the owner if the company decided to sell off all of its assets and pay back all of its liabilities tomorrow. This number right here is the true net worth of the business for the person who owns it. And that slice of the pie isn't just sitting there. It's always changing, always in motion. As you can see, things like a net profit or the owner putting more of their own money in, that makes capital go up. But on the flip side, if the owner takes money out for personal use, we call that drawings, or if the business takes a loss, capital goes down. It's a living number that shows you exactly how the business is performing. Okay, so we've got our three big building blocks: assets, liabilities, and capital. But here's a tricky question. The value of assets can change all the time, right? So how do accountants deal with that kind of uncertainty? Well, they follow one simple guiding rule: the principle of caution. Now, this rule has a formal name: the principle of conservatism. But I like to think of it as the don't count your chickens before they hatch rule of accounting. It basically means that if you have a choice, you should always pick the option that makes the business look a little less fantastic. The goal is to never, ever overstate how well you're doing. Let me give you a really clear example. Imagine you own a small shop and you bought a big batch of inventory, let's say sweaters, for $500. That's your cost. But fashion is fickle, and by the end of the season, those sweaters are out of style.
If you tried to sell them today, you'd only get $450. That's their market value.
So you're doing your end of year books. You have to put a value on those sweaters sitting in the back room. Which number do you use? The $500 you paid or the $450 they're actually worth right now? What do you think?
You got it. You have to record the lower value, $450. This is that principle of caution in action. And why? Well, because saying those sweaters are worth $500 would be misleading, wouldn't it? It would paint a rosier picture than reality. It would be overly optimistic. And that simple choice tells you everything you need to know about this principle. By always choosing the lower, more realistic value, you're building trust and being transparent. It's a reality check that is baked right into the rules of accounting, and it's what keeps financial reports grounded, honest, and reliable. So there you have it. Assets, what you own. Liabilities, what you owe. Capital, what's left for the owner. And the principle of caution that keeps the whole thing honest. See? These aren't just boring terms. They're the basic grammar you need to read the language of business. So the next time you look at a financial statement, don't just see numbers. Ask yourself, what story are these numbers really trying to tell me?